understand this market for family offices in the next 20 years will be larger than the private equity, venture capital, hedge fund markets combined. So this is a massive market. But you were still very early in this. And I do think that there's a lot that has to happen for family offices to be able to compete directly with venture capital. It'll never replace venture capital, ever, but it's going to disrupt it.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Ronald Diamond with us. Ronald Diamond is the founder and chairman of Diamond Wealth. He's a long-time investor and entrepreneur, investing alongside 100 family offices ranging in size from $250 million to $30 billion. Diamond Wealth invests in private markets, that is, private equity, venture capital, and real estate. In this episode, we talk about what is Diamond Wealth, how do family offices approach investments into alternative asset classes, what percentage allocation to private equity and venture capital get in family office wealth, how family office capital will surpass private equity, venture capital, and hedge funds combined, how family offices can provide patient capital that venture capital or private equity cannot, how family offices can give a serious competition to private equity, and so much more. So without wasting any time, let's dive straight in.
This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Ron, so good to have you on the VC 10X podcast. How are you doing?
I'm doing terrific. Thank you for having me.
It's a pleasure having you on. To start things off, can we first have your story and what you're doing at Diamond Wealth?
Sure. So real briefly, I graduated from Northwestern, got a job at Drexel Burnham, which at the time was the most profitable firm on Wall Street. Drexel lasted for about 2 more years and then they imploded. And then I moved back to Chicago, and this was in 1990, and started a hedge fund. So I ran a hedge fund from 1990 to 2000, started with a couple million, ran it to about 250 million. Um, Had a good track record, never had huge returns, but we beat the S&P 10 out of 10 years. And then I sold the company to a market neutral firm, stayed on board 6 months, kept all the assets there, and then I left and started my own company, which is what I'm doing now. And what I do now, it's Diamond Wealth. And basically, we have a syndicate of about 100 single family offices that I invest alongside. And these are families anywhere between 250 million to 30 billion. And I kind of act as a point person, and we invest in the private markets. So that's private equity, venture capital, and real estate. And we're typically, I know who likes what. So if it's venture capital, which I know is a lot of your audience, there's probably 40, 45 people who like venture space. And then if it's like pre-seed, or depending on how early it is, I'll know who likes specifically what aspect of venture. And then we go ahead and we'll structure an SPV and invest. And we've invested as little as 2 million and as much as 200 million per deal. And I sit on some advisory boards, and as I also am in the process of putting together a family office initiative at one of the leading universities in the world.
Absolutely. That's an incredible initiative you built there. And how do you get in touch with all these wealthy family offices, and why do they choose to work with you? What are their motivations here?
Well, I'll answer your first question first. The first question, when I ran my hedge fund, they didn't call them family offices. They used to call them rich people. So I had a bunch of rich people who are now called family offices. So that's kind of how I got into the family office space. Because remember, I mean, the term family office, I mean, it's been around for, you can go back to the Medicis, but in the U.S., probably late 1800 with Rockefeller and Vanderbilt. But truly, the family offices now that when you hear the term, 68% of the family offices that exist today started since 2000, and half of those started since 2008. So this is a very, very new industry. And the interesting thing about it is the model doesn't work. Only 25% of families make it to the second gen, 10 make it to the third, and 5 make it to the fourth. So you've got huge amounts of capital, which is $10 trillion. You've got, which is, just to put it in context, there's 6.5 trillion globally in the entire hedge fund universe. But more important than that, you've got 84.4 trillion coming downstream from the baby boomers of the next gen in the next 20 years. So we're about to experience the largest transfer of wealth in history. Having said that, it's still a very inefficient, fragmented, and siloed market. We're maybe in the second or third inning, but I do believe that as private equity and venture capital disrupted the public markets in the mid 80s, that family offices are going to start to disrupt the private equity markets. And so I think we're at a very, very fascinating time, and it's changing in real time.
Absolutely, that's incredible insight there. And at Diamond Wealth, how are you trying to bring that structure and that process to family office investing? And what are you trying to introduce so that they get more structure in their investing into alternative asset classes?
Well, I've surrounded myself with people that are kind of smarter than me in various areas. So if it's SaaS or if it's early, if some kind of technology or whatever, I try to find people. I used to chair the Disruptive Technology Center, the advisory board for Stanford University. So I've got access to a lot of pretty smart people at Stanford and now a couple other universities. So I'll have them help out, and then we do due diligence, and then uh, we've got access to a lot of family office. A lot of people have made their money in different areas. So if this is a SaaS deal, I would go to a family office who sold their money and made their money in SaaS and talk to them about that and have them help me with the due diligence.
Yeah, that's super interesting. And all these family offices, do they all come with a specific thesis they want to follow in how they want to approach their investing, or are they pretty random about it?
They're all over the place. There's no no two family offices are alike, and they all look at things differently. You've got on the one end of the spectrum, you've got the Pritzkers. Paul Carbone's a good friend, and they've got a team of 65 people who vet deals. And then on the other end of the spectrum, which is more of the reality, is a guy who sells his chain of gas stations for $500 million, and he has a son-in-law who just graduated from Indiana is a CIO, and that's the whole team. So there's a huge range of, and that's why I think we're only in the second or third inning in the evolution of family offices.
Absolutely. And let's try to understand the composition of the investing these family offices are doing. What are the different asset classes that they are more interested in? And also, specifically talking about the venture capital asset class, how much of an allocation does this asset class get from family offices?
Right now, I would say the private markets in general have continued to go up, and that would be private equity and venture capital and real estate. And the public markets have continued to go down. So, roughly, it's almost 50-50 right now in private markets versus public markets. And specifically to venture, I would say anywhere between 5 to 10% on average are what most family offices. Obviously, if a family made their money in a tech space or in venture, they're going to allocate a lot more than 10%. I've seen it up to 25%, but I think 10% is a good number.
Absolutely. And when these family offices are looking at, or maybe you as a person of point of contact are looking at venture capital funds or fund managers and evaluating those deals, whether you want to make LP deployments into those funds or not, what are the kind of things you're looking for in them?
Well, we typically don't. We have invested in funds if we have to. I like to do direct deals. So there are some funds that, in order to get access to the direct deals, you have to invest in the fund, and then we'll put the minimum amount in to invest in the fund. But really, what we do, what our specialty is investing in the direct deals. And that's really what we look to do.
Absolutely. So you're trying to position family office investing as a direct competitor to private equity investing. Is that correct?
Correct.
Awesome. And what do you think is lacking in the family office space for it to not be currently a very solid competitor to private equity?
Oh, we're still so early. I mean, you've got some firms
Hmm.
like the Pritzkers or the Dells or the Crowns or Sergey Brin. They've created family offices and they've institutionalized it, right? So they can compete directly with Carlyle or Blackstone or KKR. But that's the exception. There's maybe a handful of them. Right now, the vast majority of them can't. But I do think this is changing in real time because as you see 84.4 trillion, I mean, understand this market for family offices in the next 20 years will be larger than the private equity, venture capital, hedge fund markets combined. So this is a massive market. But you were still very early in this. And I do think that there's a lot that has to happen for family offices to be able to compete directly with venture capital. It'll never replace venture capital, ever, but it's going to disrupt it. And part of the reason is that the biggest advantage that family offices have is something called patient or permanent capital. So they don't there's not an artificial time frame. So the issue with private equity and venture capital in general is a lot of it's become an AUM game, and these funds have become massive, probably too big. And the problem is that the incentive is they'll buy a company, they'll hold it for 3 to 5 years, and then they'll sell it. And then that's how they're incented. So if you look at it, what happens is, let's say a venture capital firm or private equity firm buys a company from a family-owned business, and they're going to hold it for 3 to 4, maybe 5 years, and then they're going to sell it. And the reason they're going to sell it is because that's how they're compensated. They'll sell it, but oftentimes they're going to sell it to another private equity firm. So you get private equity from A who's sold it and says now's a good time to sell, and private equity from B who also smart people who think it's a time to buy. And over the course of 20 years, you could see this firm bought and sold 4 to 5 times. And if you look at the friction, the taxes, the disruption in the business versus a family office who could simply buy it, hold it for 20 years, and let it compound, the results aren't even close. The problem is very few families can do that. What I believe is over the next 5 to 10 years, more and more will.
That's very interesting to learn. And family offices, so there are two approaches they can take. One is that they make as a limited partner deploy into private equity funds or VC funds. That's one approach, and the other is direct investing, as what you are trying to do at Diamond Wealth. How would you compare the two, and why do you recommend the direct approach?
Well, I wouldn't recommend the direct approach for most people. You need to have and one of the issues, you raise a really interesting point. Um, we do, but we've got a team of people who can diligence this. The problem was that post crash, pre-COVID, no matter what you invested in, I don't care if it's venture capital, private equity, real estate, the stock market, Bitcoin, everything went up. So what happened was a lot of these family offices said, "Well, why do I need to go to these venture capital funds and pay 220 if I could do a direct deal and make money?" And it made sense until it didn't. And what happened is about 2 years ago, when the Fed started jacking up interest rates, people realized that if you're going to be in venture capital in particular, you either do it full time or you don't do it. Period. Full stop. And what happening is a lot of people were doing these direct deals and making money because they've got huge tailwinds and they thought it was easy, but it's not, as you know, and your audience knows. So I think you're going to see a pullback in a lot of these families that did the direct deals previously. They're not only now not making money, they're actually losing money. Carter did a study where the average Series B, direct deal was down like 50%, and the average Series C was down 75%. So because of the pain that the families are feeling right now, they're reevaluating how they invest. And I think what's going to happen is there's going to be a pullback, and rather than invest directly themselves, where they thought they were smart and they could make money, they're going to go to experts like you or people in your audience who are experts specifically in venture capital, and they're going to outsource it. So I think it's a big opportunity for people in the venture capital space to get access to family offices because they have experienced losses over the past 2 years.
Absolutely. That's super interesting insight, especially at a time when fundraising for GPs isn't as easy in this environment. So, family offices can be a very good target for them. But how do you recommend GPs, and especially emerging GPs who are new in the market and raising their new funds, but do have an expertise in a particular sector or an area, should reach out to family offices, where to find them, and build relationships with them?
Okay, so that's the $64,000 question, and so right now, it's very inefficient. So the question really is, how do the smart guys find the rich guys, and how do the rich guys find the smart guys? Right? That's really what your question is, and there is no real mechanism for it. So what I tried to create at Stanford was a mechanism to do that. We're in the process of doing that at one of the top universities in the world. I can't deny it'll be announced publicly in the next, I think, 60 to 90 days. We're trying to do that so that if you're a kid coming out of Chicago or Northwestern or Stanford or Wharton or wherever, and you've got an idea, right now, you go to NEA or Sequoia or some of these big firms. The problem with going to those firms is that you're one of 20 portfolio companies. And if your business doesn't hockey stick up after a couple of years, even if it's about to, they could very easily just sell it. And so that's why it's better to work, in my opinion, in most instances with family offices, but it's hard for these entrepreneurs to find them. So what I'm trying to create is an ecosystem through a university, because I can go to PitchBook and I can find out who are the top venture capital firms. I can go to PitchBook and find out who are the top private equity firms. I can't go to PitchBook and find out who are the top family offices. And what family offices have to do is they have been private, and that's their prerogative. They made their money, they could do whatever they want. But if they want to compete with and get access to the deal flow, they have to let the smart people, the entrepreneurs, know what they're doing. So a lot of it is on us, on the family offices, to come out and say, we invest in venture capital. We don't do pre-seed, but we invest in series A, B, and C. Our average check size is this. We do these following industries. We won't touch these industries. And it's up to the family office to educate the market on what they look for, so that way the entrepreneurs can go directly to family offices. It doesn't exist today. It exists in a very haphazard, very random, very inefficient way. I'm trying to solve for that, but it's going to take 3 to 5 years to do that.
Absolutely. And do you think there is a willingness for family offices to be more public about it, that they are
There has to be.
investing directly?
Absolutely. There has to be. And again, I make no judgment. I mean, if a family wants to be private, that's fine. They could stay private, but they're not going to be able to compete directly with the Blackstones or the Carlyles of the world, right? So if they want to compete, they have to become more public and say this is what they're looking for. If they don't, they can't.
Absolutely. And you mentioned how these family offices have actually made their wealth in particular areas and sectors, and they can be great investors for newer businesses in those areas, right? Uh, and can you give us any examples of such family offices who made their wealth in a particular area and are now interested in investing into newer companies in that area, or maybe a VC fund that is focused on that area?
Well, I'll give you the opposite first, because I think that's really the problem with the industry, and I think where there's a big opportunity for people in in your world, in the venture capital world. So I always pick on Ty Warner, and again, he's a visionary businessman. He created Beanie Babies, and it was a multi-billion-dollar exit, and he was a brilliant businessman. Um, but that's Beanie Babies. He's tried to buy hotels. Those are two totally different asset classes. And he got crushed by trying to buy Four Seasons and all these hotels. So what's happened is a lot of these entrepreneurs who sell their company, and in order to have a family office, you need a bare bones minimum of 250 million in order for it to make economic sense. Anything short of that, you're better off going to a multifamily office. But if you sold the company for 250 million or more, and you can do that, um, there's huge amounts of capital in very inefficient hands. And what's happened is a lot of people who made money in something think that because they made money in real estate or in private equity that they can make money in venture capital. They're completely different skill sets. And in particular with what you do in venture capital, it is the hardest asset class to invest in, period. Now, if you're good, it's a phenomenal asset class to invest in. If you're average and you do it part-time, I wouldn't do it. So you really have to be focused. And I think that's why the families are going to start turning back to the experts like you and a lot of the people who are your listeners, because they realize that there is a skill set. It's hard. You can't just go to a country club and hear a friend of yours say, there's a great tech deal. He made his money in real estate, but because he's a smart guy, I'm going to invest in the deal. So I think it's really backwards, but I think that's starting to change.
Absolutely. And you mentioned how a lot of these family offices are actually one and done family offices. They come up and then the next generation, they're not there, right? So tell us what happens to them and how should they try to be a multi-generation family office that goes on for generations to come?
Okay, one, that's what I'm trying to solve for, right? Because I think we're at an inflection point. So again, the statistics, 25% make it to G2, 10 to G3, 5 to G4. Why is that? Well, what happens, I think, in general, is that when somebody has a liquidity event, the first thing they do, let's say they sell their company for $1 billion, and the first thing they want to do is invest. They want to invest in, they're now all of a sudden everybody's clamoring to these people because it's public knowledge. You just sold your company. They're showing real estate deals, they're showing venture capital deals, there's some private equity deals, and these people are all typically pretty good at what they do, and they start investing. That's the worst thing you should do. What's the first thing you have to do is the boring stuff. You have to go to the first. What I advise families after they've had a liquidity event, I said, don't invest for 6 months to 12 months. Go to an estate planning attorney and get the structure, because it's like the foundation of a house. And without the foundation of a house, um, it's not going to hold up. So I think part of the problem is that people have liquidity, and all of a sudden their friends say, "Oh, I've got this great deal," and they'll throw 1 million, 2 million, whatever the number is, into it, and that's the last thing they should do. You have to structure this with an estate planning attorney, which is the foundation of a house, and then once you've done that, then you can start investing. But 95% of the families do it in reverse. And that's the main reason. And the other reason these family offices don't make it in general, in my opinion, is the ego of the founder, the matriarch or patriarch. Because you made $1 billion, which is, again, it's a tremendous amount of money in selling widgets, doesn't mean you're good in SaaS, right? So you've got an ego of these founders who think because they've made so much money and done so well in something that they can translate, and it typically can't. So those are the two primary reasons why, in my opinion, the family offices don't make it to past second or third generation.
Absolutely. Great answer there. And you mentioned about how family offices can be a great source of patient capital for startups and even for businesses later in the stage, right? But when it's patient capital, and you just mentioned how there is a lack of knowledge or wisdom in a way in family offices in how to invest. So if they are making a long-term bet on a company or a business, how will they know when to exit that business? What's the right time for that?
I think most people, and again, even in the venture and private equity world, you kind of know when the right. I mean, it's not complicated. I mean, the reason these companies are sold every 3 to 5 years is because of the way the general partners are compensated, and that's not bad. It's just the way it is. So if they're comped to sell companies every 3 to 5 years, they're just not going to hold it for 20 years. They will not do that. Um, and so that's part of the problem. So I think we're at kind of a tipping point where once we get the family offices to become more efficient and less siloed and less fragmented, and we're not there yet, but once we do it, and I'm trying to do it through a university, and I think you have to do it through a university because they've got the research and they don't have another agenda. Like if I did it through Northern Trust, at the end of the day, they're going to want you to deposit money at Northern Trust. If I do it with Goldman Sachs, they're going to want you to invest in their products. But by doing it through university, It's pure, and they're looking for research. So that's why we had to do it with that. So it doesn't exist today, but I think we're at an inflection point, and over the next 3 to 5 years, you're going to see a massive shift, and more of these family offices are going to become the go-to places for people in venture seeking capital.
Absolutely. And like you mentioned, there is a massive growth in the amount of family office capital that is there. And even in the recent years, that's starting to surge even more. So, how do you see that trend? And how do you think should the family office space evolve in order to start competing with private equity and other structured asset classes because of the growing amount of wealth there that needs to be managed sensibly?
Well, part of the thing they have to do is you have to look at the compensation, right? So you've got to have a good team. So if a family office wants to compete with Carlyle or KKR, you know, Paul Carbone's done it with the Pritzkers. He's got a team of 65 people. Michael Dell's family office did it. Crown's family office have done it, but that's the exception. Most haven't. And I think the biggest thing right now is right now, and again, I'm generalizing, but if a family office pays a kid $250,000 out of Stanford, most of them look at that as a cost. In other words, that cost me 250,000. If KKR or Blackstone or Carlyle hires a kid out of Stanford and pays him 250, they look at that kid as a potential $20 million profit center. So it's nuanced. They don't look at it as a cost. They look at it as a potential profit center. And until family offices get the compensation part right and can compensate these people, they'll never be able to compete. Once they get the compensation right and they start giving these people part of the carry, part of lines of credit, forgivable loans, part of the deal, they're not going to be able to do it. The smart ones are. I did a podcast with Tony Pritzker, and again, they've done an incredible job. Paul Carbone's done a phenomenal job. And the only reason Tony was able to hire Paul was a very successful private equity guy at Barrett, and he was doing extraordinarily well. So there's no way Tony's going to be able to lure Paul away from a very lucrative firm unless he figures out ways to compensate him, giving him part of the carry and part of the deals. That's one of the major things that has to happen. It isn't happening yet. It's going to happen. And I think over the next 3 to 5 years, you'll see more and more families. The compensation structure will look more and more like the private equity and venture capital structure of the big firms. And once that happens, then they'll be able to compete directly because they'll have the talent pool to do it.
Absolutely. That's very interesting insight there that they'll need to take the compensation model, at least from private equity folks, to retain that kind of talent and, flourish in terms of returns at the family office, right? And there are different asset classes that family offices are looking at. Like you mentioned, there's real estate, there's private equity, and within that, there's venture capital, right? The hedge funds, right? So can you help us compare all these different asset classes and which one offers the best return to risk profile and which one is probably the worst? So help us compare all these asset classes in these.
Sure. Well, right now in family offices, roughly 23% are in private equity, and which would include venture, and roughly 22% is in real estate. So those are the two biggest asset classes, and they are because they've been historically been the most lucrative. Also, a lot of the reason is a lot of the family offices that exist made their money in real estate or in private equity. So that's they're more comfortable with that. In specifically in venture, again, it's a niche industry, and you have to really be focused on it. I tell people all the time, it's a phenomenal asset class to invest in if you have the right team. It's an incredible asset class, but without the right team, you shouldn't even touch it.
Absolutely, totally agree to that. And my last main question before we go for the close: what do you think family offices are doing, especially in the current market where there is kind of a slowdown in the venture ecosystem or even in the private equity space? Has that kind of reflected in how family offices are doing their investing, or do they not care about how it's moving at all and they are just moving forward with their investments?
Well, remember, IRR is a moot point for a family office. They would rather buy something and let it compound over 20 years rather than sell it in 2 years because they've got the taxes and all that stuff. So I think that that's what you're seeing right now. And I think that we're at a period where more and more family offices, as they become more sophisticated and learn about this, and that's one of the reasons we're trying to create this at an academic institution, because there is no playbook for this right now. The right now, I would tell you that 75 to 80% of the family offices that exist, in my opinion, shouldn't exist. I make no judgment on anybody. If they made money, they could do whatever they want with it, and it's up to them. But there's a ton of family offices that are worth under $250 million, and in order for it to make economic sense to invest to have your own family office, you need a bare bones minimum of 250. Some people would say 500 million if you're going to invest in the private markets. And yet, there's a lot of family offices that have sold their company, or they call themselves family offices, for 75, 100, 150 million dollars, and it's just not enough capital. You're better off. That's why the multifamily office is there. So rather than pay you for your own admin, your own lawyer, your own tax guy, you're splitting that with 20 families. So I think that people have to understand how much you need, and if you reverse engineer it, you can see why you need a bare bones of $250 million. Um, it's statistics like these that people have to understand and say, yes, I sold my company for $70 million. That's a tremendous amount of money. It's just not enough for a family office. The multifamily offices are for families between 10 million to 200, 250. Anything over 250 is where, if you want to do it full time, you can create a single family office.
Absolutely, makes sense. And now let's do the rapid fire round. I'll ask you 5 quick questions about the investing you're doing via Diamond Wealth, and you have to give 5 quick answers. Sounds good?
Sound good?
Awesome. So the first one is, what are the sectors and regions you invest in?
Private credit, single family rental, last mile logistics, and real estate.
Awesome. What's the typical stage of investment where you come in?
Uh, Probably EBITDA of 3 to 10 million, lower middle market.
Okay. What's the typical check size you put in?
It's all over the place. I'd say the average is probably about 20 million.
Okay. Where can business persons apply for funding in case there's a direct way to get in touch?
We have they can certainly. I'm fairly active on LinkedIn, and we have a podcast, Family Office World Podcast.com, and I've got a website, diamondwealthstrategies.com. So it's easy to get in touch with me one of those three ways.
Awesome. And just to confirm, do you entertain GPs pitching you for their VC funds?
Yes.
Awesome. Last one, where can our listeners follow you?
Again, through LinkedIn, I've created a pretty, I've got 30,000 followers on LinkedIn. We've got a newsletter right now out, which you can sign up for, and you can get on that. And then the podcast, FamilyOfficeWorldPodcast.com. So those are one of the 3 different ways to get access to it.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Ronald. It's been an amazing conversation, and I hope you have an amazing day.
Thank you. Thank you for your time.
Thank you. My pleasure.